It is 11:47 p.m. You have been awake since 6 a.m. Your back aches, your eyes burn, and somewhere between the third cup of coffee and the moment you realized your paycheck already evaporated before it even cleared, something inside you quietly whispered, "There has to be a better way." That whisper, that is not weakness, that is your financial intuition finally cutting through the noise. Here is what is fascinating. The person sitting across from you at the office, the one who seems suspiciously calm about money, the one who does not flinch at inflation headlines or panic when the market drops. That person is not luckier than you. They are not smarter than you. They simply discovered something that most people will never be told. They discovered what analysts who have reverse-engineered the last 5 decades of Berkshire Hathaway shareholder letters call the invisible architecture of wealth. And today, we are going to build it, together, from absolute zero. Now let me be absolutely clear about this. The conventional financial advice you have been handed, the spend less, save more, maybe buy a lottery ticket version of wealth building, is not just ineffective. It is, mathematically speaking, a recipe for staying exactly where you are, just with more guilt. The ordinary, exhausted worker does one of two things when January arrives, with nothing in the account. They either panic budget with the ferocity of a drill sergeant and quit by February, or they scroll through social media watching other people's highlight reels of passive income, feel terrible, and do nothing. Neither of those is a strategy. Neither of those will change the math. The financially autonomous person, the one quietly building a life they no longer feel the desperate need to escape, does something radically different. They do not chase speed. They do not chase trends. They chase architecture. This video is going to ignore conventional advice entirely. We are going to reveal the hidden mechanics that the Berkshire Hathaway model has validated over 50 years of compounding. And yes, it works even when you start with nothing, especially when you start with nothing. Here is exactly what we are going to cover. First, we will break down the psychological and mathematical mechanism that keeps most people financially stuck, despite working harder every year. Then we will examine the hard data, the biology, or the math, and the specific Buffett principle that validates the quiet strategy we are advocating for. And finally, we will give you a precise, 3-step, low-friction protocol you can begin implementing tonight. No 5-figure trading account required. If this kind of thinking resonates with you, leave a like. It takes 1 second, and it tells the algorithm that people actually want to think about money clearly. Now, let's get into it. Here is the invisible trap that keeps the vast majority of people stuck. And I want you to really hear this. It is not your fault. The human brain was not designed for 21st century financial complexity. It was wired for immediate threats, immediate rewards, and immediate survival. When a saber-toothed tiger charged your ancestor on the savannah, think long-term was genuinely terrible advice. And this neurological reality, the deep-wired preference for what psychologists call hyperbolic discounting, means that when you are staring at your rent, your groceries, and your credit card bill simultaneously, the idea of setting aside $50 for a retirement account that will not pay out for 30 years feels not just difficult, but biologically absurd. Your brain registers it as a threat to current survival. This is not a character flaw. It is biology. And every single financial system designed for the mass market, the payday loan, the buy now, pay later scheme, the 22% APR credit card, is perfectly engineered to exploit that biological reality. So what do most people do? They reach for the Band-Aid. The most common Band-Aid is what financial culture calls aggressive budgeting, an extreme restriction of spending, are usually launched with enormous willpower on January 1st, and usually abandoned by mid-February with a shame spiral and a large pizza. The second band-aid is the side hustle, the frantic addition of income streams, often at the cost of sleep, health, and meaningful relationships. Now, supplementary income is not inherently bad, but when it is pursued from a place of panic rather than strategy, it simply accelerates the hamster wheel. You are running faster, not escaping. Research into behavioral economics reveals a disturbing pattern. People who implement extreme budgets and aggressive hustle routines without a structural foundation experience decision fatigue within weeks. Decision fatigue, the measurable deterioration of decision quality after prolonged periods of self-control, means the very effort of maintaining the budget is what causes it to collapse. Willpower is a finite resource. The system most people use burns it as fuel. The Berkshire methodology treats it as something to be conserved. People who build extraordinary, resilient lives understand a fundamental truth. The goal is never short-term survival. Short-term survival is a treadmill with better scenery. The goal is to engineer a system, a quiet, mostly invisible infrastructure that compounds on your behalf. Even while you are asleep, even while you are distracted, even while you occasionally fail. The Buffett principle does not ask for perfection. It asks for structure. There is a monumental difference between the two. Or perfection is fragile, structure is anti-fragile. And 2026, regardless of what you have or do not have in your account right now, can be the year you install the structure. Let us talk math for a moment, because this is where the philosophy stops and the proof begins. The S&P 500, despite wars, recessions, pandemics, political chaos, and enough market crashes to give anyone an ulcer, has delivered an annualized return of approximately 10.5% over the last century. That number is not a sales pitch. It is a historical measurement. Now, here is where compounding becomes genuinely astonishing, and where most people's eyes glaze over because they do not believe the numbers until they run them personally. So let us run them. If you invest just $300 per month, that is $10 per day, as the cost of 2 coffees and a sandwich in most cities, into a low-cost index fund at that historical 10.5% average annual return, here is what the math produces. After 10 years, approximately $62,000. After 20 years, approximately $231,000. After 30 years, approximately $706,000. On a total personal contribution of just $108,000 over 30 years. The remaining $598,000 was generated by the architecture, by compounding doing what compounding does when you leave it alone and stop panicking. This is what mathematicians call an exponential function, and what the Buffett principle simply calls patience weaponized. Now let us anchor this to the oracle himself, because theory without evidence is just poetry. In his 2013 letter to Berkshire Hathaway shareholders, a letter that analysts consider one of the most important documents in modern investing, Warren Buffett outlined the exact instructions he placed in his will for the management of his wife's trust after his death. The instructions were not complicated, they were not exotic, they were spectacularly boring. He directed the trustee to put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund, specifically suggesting Vanguards. That was it. No options strategies, no leveraged crypto plays, no real estate syndications, no chasing the next hot sector. Research into Berkshire Hathaway's model reveals something that seems almost paradoxical. The most sophisticated investor in modern history was a man who has studied thousands of companies and made bets worth billions, ultimately concluded that the best strategy for most people is the quietest one available. The Buffett doctrine suggests that the most expensive thing most retail investors possess is not a bad stock pick. It is overconfidence in their own complexity. The elaborate, multi-platform, constantly monitored portfolio is not a sign of sophistication. It is a sign of expensive anxiety. And here is the part that should be a little humbling. Buffett built Berkshire on finding undervalued assets. He spent decades analyzing balance sheets, cash flows, and management quality, things that require extraordinary expertise. And then he turned around and told the rest of the world, "Do not do what I do. Buy an index fund, hold it forever, and go live your life." That is either the most generous piece of financial advice ever given, or the greatest act of honest self-awareness in investing history. Either way, the math supports it entirely. Let's get practical. But before the steps, a critical instruction. Do not approach this protocol with military discipline. Do not white-knuckle your way through it. Do not build a color-coded spreadsheet that you maintain for 12 days before the guilt of abandoning it makes you quit entirely. We have already established that willpower is a finite resource. We are not going to burn it on administrative theater. The architecture we are building is gentle, low friction, and forgiving by design. Think of it not as forcing yourself to change, but as quietly rearranging the furniture so that good decisions happen almost automatically, as this is what behavioral economists call choice architecture, and it is far more powerful than willpower over any meaningful timeline. Step 1. Build the moat, the defensive move, which takes 1 to 3 months. A core tenet of the margin of safety is protect the downside before chasing the upside. Warren Buffett's first rule of investing is famously never lose money. His second rule is see Rule 1. He is funnier in writing than people give him credit for. For someone starting with nothing, the first structural move is not stock picking, it is cushion building. Your goal in the first 90 days is to construct a financial buffer, a personal emergency reserve that insulates you from the predatory financial products that target vulnerability. Here is the execution. Open a high-yield savings account, entirely separate from your checking account, with a different bank if possible. Separation creates psychological friction. It becomes slightly harder to impulsively spend money you cannot immediately see. Automate a transfer, even $25 per paycheck, into this account the moment your salary lands. Automation eliminates the decision. There is nothing to resist if the money moves before you can touch it. The target is 1 month of essential expenses, not 6 months, not yet. 1 month. Because 1 month of runway is the difference between a bad week and a catastrophic financial spiral. Simultaneously, and this is the Berkshire insight that most personal finance channels miss entirely, Step 1 is also about your human capital moat. Research into Berkshire Hathaway's model reveals that Buffett evaluates businesses almost entirely on the strength of their competitive moat, their ability to defend market share and command premium pricing. When you are starting from zero, you are the business. Your skills, your specialized knowledge, your irreplaceability in your professional field. These are your moat. In months 1 through 3, identify the single highest leverage skill improvement within your current field. Not a new career pivot, too slow and too expensive. Within your existing circle of competence. The skill that would make you meaningfully harder to replace and would justify commanding a higher rate for your labor. Invest in that skill deliberately. Books, courses, mentorship, practice, 30 minutes per day. Compounding applies to knowledge as ruthlessly as it applies to capital. Step 2. The focused investment, the offensive move, which takes 4 to 9 months. Once the cushion exists, the architecture shifts from defensive to offensive. This is where the Buffett principle begins its quiet, unglamorous, statistically validated work. Here is the execution. Open a brokerage account, ideally a tax-advantaged retirement account, such as a Roth IRA or equivalent in your country. The tax advantage is not incidental. It is the difference between compounding your full return and compounding 70% of your return. The government's cut, deferred for decades, is a significant free accelerant. Automate a monthly contribution into a single, low-cost S&P 500 index fund. Vanguard, Fidelity, and Schwab. The specific platform matters far less than the automation and the cost ratio. Look for an expense ratio below 0.1%. That is not a typo. Below 0.1% annually. This is not a luxury product, it is a commodity, and commodities should cost commodity prices. Implement what behavioral economists call a set-it-and-forget-it protocol. Do not check the balance daily. Do not read every market headline. The margin of safety in personal investing is, paradoxically, the discipline to do almost nothing after the initial setup. Every unnecessary action in investing is an opportunity for your emotional brain to override your rational brain. This step also requires what the Buffett doctrine calls defining your circle of competence. As surplus capital begins to grow and the financial media begins suggesting more sophisticated alternatives, leveraged ETFs, sector rotation, individual stock picking, the protocol demands a simple, repeatable question. Do I understand precisely how this asset generates cash flow, and can I explain it clearly to a 10-year-old? If the answer is no, the answer is no. The index fund stays. The exotic product does not enter the architecture. This is not cowardice. It is the single most profitable decision the vast majority of retail investors can make. The S&P 500 has beaten roughly 90% of actively managed funds over 20-year periods. The boring strategy is not the consolation prize. It is frequently the winning strategy. Step 3. Future self-preparation. The maintenance move, from months 10 to 12. The final phase of the 12-month architecture is not about adding more inputs. It is about removing future friction. This is the difference between a system that requires constant maintenance and one that runs quietly in the background of your life. Here is the 15-minute routine, done once at the end of each month. Review your automated contributions. Did they execute? If not, was it a technical glitch or a cash flow issue? Identify. Do not catastrophize. Review your emergency cushion. Did you dip into it? If so, what triggered the expense, and is it a recurring vulnerability? Repair the moat. Identify one friction point from the previous month, one thing that made the protocol harder than it needed to be, and remove it. The goal is not a perfect month. The goal is a slightly lower friction next month, and that is the entire maintenance protocol, 15 minutes, once a month. The Berkshire Hathaway model runs its quarterly reviews with the same deliberate restraint. Buffett has famously noted that inactivity in investing should be rewarded rather than penalized. Your monthly review is not a performance assessment. It is infrastructure maintenance, entirely different energy. By month 12, here is what you have built: a moat around your finances and your professional value, a compounding engine that runs automatically, and a maintenance habit that prevents the system from decaying. You have not made $1 million. You have done something more valuable. You have become someone whose financial architecture produces capital, rather than someone who produces capital through sheer manual effort alone. Let me be absolutely clear about this one final thing. You will miss a month. You will have an emergency that drains the cushion. You will, at some point, make an impulsive financial decision that contradicts everything we discussed tonight. possibly involving a stock tip from someone at a party who definitely should not be giving stock tips. This is not a failure of character. This is not evidence that this protocol does not work for you. This is just what human financial life looks like in practice. The architecture we have built is not designed for a perfect practitioner. It is designed for a consistent one. And consistency does not mean perfection. It means returning. It means the month you miss the contribution, you restart the next month without the weight of shame. Shame is the enemy of financial recovery. It is heavy, and it is paralyzing, and it serves absolutely no structural purpose. The Buffett principle, at its philosophical core, is built on anti-fragility, the recognition that systems designed to survive imperfection are superior to systems that require perfection to function. Compounding is anti-fragile. A missed month does not destroy 30 years of architecture. Quitting does. The internet will tell you that wealth is about the number, the account balance, the net worth figure. The 7-figure milestone you announce with a rented Lamborghini in front of a mansion you also rented. The Berkshire methodology, across 50 years of documented decisions, reveals a different conclusion entirely. The actual goal, the one hiding underneath every financial decision, every budgeting attempt, every frantic side hustle, is not capital accumulation for its own sake. It is freedom from financial fear. It is the ability to make decisions from a position of stability rather than panic. It is the quiet, invisible satisfaction of knowing that your money is working while you sleep, while you rest, while you spend time with people who matter. People who build extraordinary, resilient lives understand a fundamental truth. The destination was never the number on the screen. The destination was a life you no longer feel the desperate, aching need to escape from. That life is not built with intensity. It is built with architecture, quiet architecture, slow architecture, the kind that compounds invisibly in the background while the rest of the world is frantically chasing speed. You started 2026 with nothing. By the end of it, if you install the structure, you will have something far more powerful than a balance. You will have a system, and systems, unlike windfalls, do not disappear. That's all. Thanks for watching.